In this video, I will be talking about eliminating entries. Eliminating entries are going to be our main tool at completing our consolidation accounting. These topside entries happen outside of the general ledger and primarily serve to eliminate duplications that arrive by adding the accounting records of multiple companies together for financial reporting. For the rest of the class, it will be a little bit confusing keeping track of where we are making our journal entries, so I have color-coded our lecture slides and examples. When you see yellow, that means we are making entries on the general ledger of the parent company. When you see blue, that means we are making our entries on the general ledger of the subsidiary company. When you see orange, that means we are making our entries outside of both companies' general ledgers. In order to know what eliminating entries we need to make, we first need a refresher on our accounting for equity investments. The parent company will record their equity investment, or investment in S, at cost. The cost is measured as the more clearly evident of the consideration given or the consideration received. If we were buying the subsidiary shares with cash, then cash is the more easily valued of the two. If we were buying the subsidiary shares with, say horses, I think we'd all agree that we'd rather value the shares. We've already learned how to record our initial investment during the investments chapter. But let's take a look at an example that also illustrates why eliminating entries are going to be necessary for our consolidated financial statements to make sense. On January 1st of 2013, Peach Company issued 1,500 of its $20 par value common shares with a fair value of $60 per share in exchange for the 2,000 outstanding common shares of Schwartz Company in a purchase transaction. Just prior to the acquisition, the balance sheets of the two companies were as follows. So they provide us with the balance sheet of Peach, which is our parent company, and Schwartz, which is going to be our subsidiary company. Prepare the journal entry on Peach Company's books to record the exchange of stock. So again, this is going back to our investments chapter. We are just going to record the purchase as if we are buying anything. So what are we getting? Well, we're getting an investment in S. So that's our equity investment account. So we are creating a new asset on our books that is the shares that we are buying of Schwartz. And then how are we paying? Well, in this case, we are paying with stock. And so it says we are issuing 1,500 new shares. So whenever we issue shares, we're going to increase our equity account, common stock, and we're going to do that with a credit. And then if we are issuing our stock at a value other than par, so in this case, they told us the fair value is $60 and the par value is $20, we're also going to need to use our other contributed capital account. So just a reminder, this is the same thing as additional paid-in capital. So again, we record our investment at whichever is easier to measure. So the value of what we got, so in this case, the value of the Schwartz shares, or the value of what we gave, which in this case is the Peach shares. So since they only told us the value of the Peach shares, we're going to start there. We issued 1,500 shares, and they told us that was a $20 par value. So we're going to multiply that amount by $20, and that's what will go in our common stock account. Then for our other contributed capital, we're going to take that same $1,500 and we're going to multiply that by the difference between the fair value, which they told us was $60 per share, and our par value, which is the $20 per share we already recorded in the common stock account. So that gives us $60,000 credit to other contributed capital. So this is what we gave up. And so we know that what we got must be worth what we paid. So the value of our shares that we purchased is $90,000. So this is what we would record on the parent's general ledger when we bought the shares in our subsidiary. Now, what we're going to do is we are going to go ahead and add the two balance sheets together so that we can look at it and see why this doesn't make sense as a way to do our consolidation. It's a good first step, but we're going to have to make some adjustments. So the first thing we're going to do is we are going to adjust the balance sheets that they gave us for this new entry we just recorded. So we created a new account called Investment in S, and we debited $90,000, which would increase that asset by $90,000. We also made entries to common stock and other contributed capital. So common stock already existed. There was a $100,000 balance in common stock, and we are adding to that because a credit increases equity account. We are adding to that an additional $30,000, which means our common stock would be $130,000 after this journal entry. And then same thing for our other contributed capital. We already had $60,000 in there. We are adding an additional $60,000 to it. So that means that our other contributed capital would be $120,000 after we record this journal entry. And you'll see now our balance sheet balances again, and we can continue on with our wrong way consolidation. So remember, we're going to say, what if for our consolidation, all we did was just line up the accounts that have the same name and add across. So we're going to take Peach, and we're going to add to it Schwartz, and we're going to do that for all of the asset accounts, and then sum up our asset accounts. Then we're going to take our liability and equity accounts. We're going to add those up all the way across, and then sum them up. Okay, so as we saw in the lecture slides, this doesn't totally make sense because we have our investment in S here, and our investment in S is basically the value of Schwartz. Well, why does Schwartz have any value? Well, it has value because it has assets and liabilities. So it's really worth its net assets. So we've double counted it because we have net assets of Schwartz here, and we have net assets of Schwartz here. We also have increased our common stock and other contributed capital by Schwartz's common stock and other contributed capital. But that also doesn't make a ton of sense because we're kind of double counting there as well because we own those shares. So that's kind of here, and it's also kind of here by putting this in here because our equity is the same thing as net assets. So we've essentially double counted Schwartz kind of in two places. So what we need to do is we need to do something else. So this will be the start of our worksheet. And then over here, we're going to add on some eliminating entries that are going to help us make this make a little bit more sense. So that's what we're going to learn about next. When we consolidate the financial statements, we will do so outside of the general ledger system on our consolidation worksheet. A consolidation worksheet, in reality, could very well be an Excel spreadsheet like the one we will be using. Importantly, journal entries made on our worksheet are temporary in nature. They will not be recorded in the general ledger of either the parent or the subsidiary company. Remember that for this class, eliminating entries will be denoted in orange. Our starting point for consolidation will be to add the output of the parent's general ledger to the output of the subsidiary's general ledger. However, as we just saw in our example, that is going to cause us to double count the assets and the liabilities of the subsidiary and inflate our balance sheet in general. Eliminating entries are the process by which we will adjust this imperfect starting point to arrive at financial statements that mirror the output we arrived at more easily in an asset acquisition where we only had to deal with one general ledger. In general, eliminating entries will remove something we added from the parent general ledger and a corresponding something that we added from the subsidiary general ledger. Most of the time, these entries eliminate an intercompany transaction to reflect the fact that the consolidated company cannot do business with itself. The parent and the subsidiary might do business with each other, loan each other cash, or pay dividends to one another. However, none of these transactions can remain on the consolidated financial statements because it would be like two branches of the same bank loaning each other money. In terms of the consolidated entity, you're simply taking cash out of your right pocket and putting it back in your left. The final eliminating entry on this list is the one where we will spend the most time. This entry eliminates the equity investment account on the parent's books as well as the equity of the subsidiary. It will also record any non-controlling interest and later fair value adjustments, so it's going to do a lot of heavy lifting for us, hence why we will spend so much time on it. This is an illustration of a simple eliminating entry. Here our two subsidiaries from before are doing business with each other. Thomas appears to have borrowed money from Sanchez and recorded it as a note payable. On their end, Sanchez has recorded the same transaction as a note receivable. When we prepare our consolidated financial statements, we will add these two balance sheets together, and then we will need to eliminate this transaction because the consolidated entity cannot loan money to itself. To do this, we will record an eliminating entry on our worksheet that debits note payable because a debit will get rid of a liability, and credits note receivable because a credit will get rid of an asset. Sometimes timing differences in recording result in an intercompany transaction being present on the parent's books, but not the subsidiaries, or vice versa. To remedy this, we would first record the transaction on our worksheet as if we are the entity who has not yet recorded it. And then we can prepare our eliminating entry. In reality, we could also go back to one of the entities and ask them to record the transaction and send us a new general ledger. However, in this class, that's not going to be an option. This concludes our lecture on eliminating entries. Don't forget to email any questions for our discussion.